Welcome to ETF.com University, where we demystify the world of ETFs. My name is Dave Nottig. I'm the managing director here at ETF.com. And today we're going to talk about your actual experience as an investor, your total cost. Because expense ratios really aren't everything. There are actually a lot of other factors that affect what you pay for in your fund, what your real experience is. Before we dig in, a word of caution. There's a lot more to investing than just finding the cheapest fund. Nothing is actually more important than the actual assets you own. The cheapest large cap equity fund is a terrible substitute for a good bond fund if a good bond fund is what you need. But let's assume for a moment that all else is in fact equal, and you're looking at two ETFs that provide pretty much the same exposure. Now we're in a position to talk about your real, actual buying experience, buying it, selling it, owning it over time. The way I see it, there are three core contributors to your total cost, and we're going to discuss them today. Expense ratios, tracking difference, and trading costs. So let's just wade into each. First, let's start with the most obvious cost, which is the expense ratio. On the face of it, most people actually think that that's the total cost of owning the ETF. Back in the ETF 101 video, we discussed how, on average, mutual funds are more expensive than ETFs. And that really is true. The simple average expense ratio for an equity ETF is just 47 basis points or 0.47%. The same bucket of funds on the mutual fund side are 1.25%, obviously much, much more expensive. And the story really doesn't change if we're looking at the asset weighted average, where people are actually putting their money. ETFs average about 22 basis points there versus mutual funds 55 basis points. Again, more than twice as expensive. Now, while it's true that ETFs are generally cheaper, it's worth pointing out that different asset classes, different approaches to the market are going to be more expensive than others. Funds that are using leverage or giving you inverse exposure or tracking alternatives, they're going to be more expensive than, say, the cheapest US equity funds. I'd be remiss if I didn't show you this, though, which is how you roll it all together. This is our world's cheapest ETF portfolio, and we've been tracking this at ETF.com since about 2008. And back then, it was a shockingly cheap 16 basis points. Today, if you just own the cheapest ETF in every asset class, your weighted expense ratio is going to be just 5 basis points. It turns out, investors really care about expenses. Back in 2012, ETF giant iShares launched two dirt cheap alternatives to their big international funds, essentially competing with themselves on cost. Their emerging markets ETF, for instance, EEM, charged 67 basis points, and it was old and it was large and it traded very well. And they launched a competitor, IEMG, for just 14 basis points. And since then, year after year, we see money pour out of the old expensive funds and flood into the newer, cheaper ones. In fact, a Schwab 2018 investor study found that low expense ratio and low total cost were the most important things investors looked at when picking a fund. And while cheap is good, it is important to remember that there's a bit of diminishing returns when you're chasing expense ratios like this. Every 100% or basis point, as we usually call them, is $1 a year for every $10,000 you have invested. And getting too focused on that $1 doesn't always get you too much in returns. So that's fees. Yes, they matter, but only to a point. But what about how your fund is actually managed? If you have two funds tracking similar indexes, how do you know which one is well run and which one might have some issues? That's where something called tracking difference comes into play. Tracking difference answers a simple question. If I hold a real world fund for a year, what's my performance going to be like versus the theoretical performance of the index that I'm supposed to be tracking? Now, at a minimum, you'd expect your performance to be worse than that hypothetical index by its expense ratio. So if the index is up 10% and the fund that you're in tracking that index charges 1% a year, well, you'd expect to be up about 9%. We'd say for that period that your tracking difference was 1%. So let's look at a chart to show you what this actually looks like. So Here's that huge emerging markets ETF from iShares, the MSCI Emerging Markets ETF EEM. Now, each day, that fund will beat or miss its index by a tiny bit. That's mostly just noise. But over time, depending on when you want to measure, your 1-year experience holding that fund will be quite different than EEM's 67 basis point expense ratio might suggest. Sometimes this can be even more dramatic. Here's XCEM, a little known competitor to EEM from Columbia Threadneedle. The fund tracks a no China emerging markets index, and like EEM, you can see it has a lot of variation day to day. But when you look at 1-year holding periods, the difference here is astounding. This fund is actually beating its index consistently, sometimes by 4 or 5% on a yearly basis. Now that seems impossible, but there are actually all sorts of reasons things like this can happen. In this case, the actual index XCEM is supposedly tracking has 700 stocks in it, but the ETF chooses to only hold 100 of them. So in the past few years, that huge bet, different than the index, has paid off. But of course, it could go the other way as well. There are other things that can influence your real-world index investor experience too. Maybe the manager allows short sellers to borrow some of the stocks in its portfolio in exchange for a fee. That generates positive income for the fund, and that will show up as positive tracking error. And there are dozens of small things from how well a rebalance is executed to when trades are made versus when trades are reported in the index. All of these add up to tracking difference. The important thing to see here is that expense ratios aren't everything. So here's a bunch of ETFs covering the emerging markets, for instance, and they have wildly different expense ratios. As you go down the list, you can see that some funds really vary quite widely from their benchmarks, and the expense ratio isn't always the best way to look at it. Take a look at the FTSE RAFI Emerging Markets ETF here, PXH. Its median holding period is worse than its expense ratio, and in some years it cost you 2% effectively to hold. Hardly a cost leader here from a real-world perspective. The great thing about tracking difference is that it already includes all of the impacts of things like expense ratios and almost everything else that's going to affect your experience as an investor. I say almost because you still have to trade in and out of your position. And that's where we get to spreads. We covered this a bit in trading, but the spread is the difference between what you pay to get into a fund and what you expect when you get out of the fund. ETFs are traded in the marketplace, just like a car or a house or stocks. And so the seller is always going to want to ask a little bit more than the buyer wants to pay. That's capitalism. And spreads can and do vary wildly. Theoretically, the spreads for an ETF need to take into account all of these things, from the spreads of the underlying securities to the authorized participant making a little bit of profit, to any hedging they may have to do. All of those things should get baked into spreads. But many of the most liquid ETFs trade much more narrowly than all this might suggest. In fact, the weighted average spread for all ETFs is just about 5 basis points. So that means that if you bought and sold over a 12-month period, you'd just be losing that $5 for every $10,000 you invested. Just like tracking difference, you can look at spreads over time, and you can look at the static statistics on the tradability tab for any ETF over at ETF.com. Now, let's put this all together. Here's that list of emerging markets ETFs again. If you were only going to look at the expense ratio, you'd think that Vanguard's VWO was the clear winner here. But when we actually look at tracking difference, things change a little bit. VWO is still great. It's actually beating its index by a fair bit pretty consistently. But IEMG from iShares and our little friend XCEM that we talked about, they look very good. When we look at spreads, we can see the issue with going after this tiny fund though. Getting in and out of XCEM, on average, it's going to cost you about 1%. That's huge. That's a very wide spread. So when we roll all this up together, we can say that the true total cost of these ETFs is quite different than their advertised expense ratio. Now, because of that crazy tracking difference we saw, XCEM may look like the clear winner here, but I'd like to think that most investors will and should look beyond the cost and evaluate what this fund's really doing and whether this is truly a sustainable advantage for this fund or really just happenstance. IEMG, on the other hand, really does move to the front. This is a plain vanilla fund that tracks its index very well to the mild benefit of investors. Even with the spreads included, you're actually getting paid about 0.25% to own this fund, while VWO from Vanguard is effectively free, which is still awesome, of course. So there you have it. In future videos, we'll talk about other things that can impact your investment performance, like taxes. But I think this gives you a good start in understanding that total cost is a lot more than just expense ratio. Thanks for watching, and I hope you'll join us for the rest of the series.